Now, let's start with the difference between this one and the other one. When you use this method, what you actually do is you directly identify the uses of cash flow and outflows. This means that you don't need to review the accounting of the company in a accrual basis accounting. When you build financial statements, you use accrual accounting. That is, you recognize the financial operation when it happens, not when it's paid, or rather, not only when it's paid, because transaction can happen and also be paid at the same time. But you can have a transaction that occurs inside the company and you don't pay it until, like, I don't know, 6 or 7 months later. For example, in the company I used to work, we used to buy these blades inside the data center to create a colocation for the databases, for the software products. And what we used to do is that we bought the components, like all the hardware, inside the database, and then we start paying like 6 months later. But in the moment we got the blades, that's what those things are called, the blades inside the warehouse, or I'm sorry, not warehouse, inside the data center, we register them as assets, all right? There was no, but we didn't have a cash flow, a cash outflow of money with when we buy in that moment those assets, because we knew that we were going to pay for those assets 6 months later. But anyway, because that was accrual accounting, because you are supposed to register everything accrual, we needed to register the assets in that moment, even though we were going to pay them 6 months later. When you use the indirect method, when you do that subtraction and you see that the assets actually increase, you need to also, in that event, we also needed to see like non-cash effects and see if the assets increase was a cash effect or an accrual effect. And if it was an accrual effect, then we then consider inside the cash flow. That's for the indirect method. In the direct method, you don't take any of the accounting consideration. What you take is like the outflows and inflows of cash that you already know, and then you build the cash flow from that. You build it on a cash accounting basis. So that's the main difference between those two. You can do it, I mean, both of them are cash flows, but the difference between this one and the other one is that with the cash flow as indirect method, you need to know like that level, you need to have that level of understanding of accounting on an accrual basis for adding or subtracting different types of cash. So let's start seeing step by step how you build it. But before I move on, is this part clear?
Yes, teacher.
Okay, perfect. So let's move on. So, okay. These are the operating activities, all right? For operating activities, the first thing you need to do is to recognize what are the revenues in cash that you are generating and what are the taxes and expenses in cash you are generating. That is, you are bringing inside the company. And notice how here we are not considering depreciation. Why we are not considering depreciation? Who can tell me?
Because it is not a real cost that is going out of your pocket. It's just like something that you have in mind, but actually in money you still have it.
Okay, okay. Who else agrees or disagrees with that?
I agree, but also I'm actually not sure, but I'm going to try. Also, isn't it because the depreciation is a fixed cost, so you don't like you don't have it there? I don't know.
You are correct. I mean, yes, of course, both of you are correct. It is a fixed cost. You also have fixed cost inside cost and expenses. You could have like a rent there that is fixed, and that doesn't mean that you don't need to add it in direct method. What tells you that you don't need to take into consideration the depreciation? It's because depreciation it's not a cash expense. It's an accrual registration for the wear of the machinery. So that's accrual accounting. In the other one, in the indirect method, we added it back because we are using accrual accounting to determine the cash flow. Here, you know which are your cash inflows and your cash outflows, and what you do is you register those inflows and outflows just like that. You don't take difference or anything. You just register the inflows and the outflows. Okay, so For operating activities, this is how you will get the information. For example, look at the right part of the slide. You have the income statement there, and because we know on this particular example that we don't have neither clients nor vendor accounts, we know that we are selling and collecting all the sales in the same month that we make the sales, and we are paying our vendors in the same month we actually have the period expense. So that's why we are registering like the same amount you have in the income statement. We are registering here as sales revenue in the cash flow. It will be different if you had a company that you know that maybe you have sales of 10,000, but you only get paid half in that sales and cash sales. You only get paid half of that money in that period. So in this example, for example, what I'm writing down here with my pen, if you have 10,000 pesos in sales and you only get paid 5,000 pesos in sales, and you get owed from clients 5,000 pesos, which one of these will you have to write down inside the cash flow?
Sales, right?
Sales?
In the cash flow? I mean, no, I mean what you get, like what you're receiving.
Exactly, that is the cash sales. Okay, and talking about the vendors, it's also the same. Here we don't have the difference between vendor accounts. Instead, what we have are the sales costs on cash, the operating expenses on cash, and the taxes paid on cash. And we take the cost from here. Again, we know that we pay the vendors in the same period that we actually incur in the expense, so we write it down as it is. And then we take the operating expenses, but right now we don't do any subtraction. What we do is just add up from here to here, or well, you can subtract this one from this one. The idea is you don't take into consideration the depreciation, only the cash expense, all right? And that's what you write down here. And then you have the taxes. To take the taxes, of course, because it's a cash expense, and you put it down. And the addition of all of this is going to give you the cash from operating activities. Okay, guys and girls?
Yeah, everything's clear.
Okay, so if everything's clear, who wants to share her or his screen to show us?
Teacher, one question. Is that like another way to see it? It's like, I'm going to say it in Spanish because I don't know the translation. ¿Es como un análisis de aplicación de recursos, o sea, en parte o no?
Well, yes, you can call it that. Actually, I remember like my dad, like from a long time ago, he used to call the cash flow that aplicación de recursos. I think that was the name of the cash flow like a long time ago.
Oh, right.
So yes, you are correct. I mean, technically, it is not called like that anymore. But yeah, you see where you are applying.
Sí, antes se llamaba estado de origen y aplicación de recursos.
Thank you, Karina. You see, Jesus, so it's the same thing now.
All right,
it's changed the name and all because, again, as we saw in the last class, there is a board that decides that, and they changed the name, but it's the same.
And really, a very quick question. I heard a principle about this, that it's supposed that with the incomes you have on the short term, you should pay the debts on the short term, and the incomes from the long term should pay the debts from the long term. How does that work? Like if I'm not si no me desvío mucho el tema.
Well, you are not actually diverting from the subject, because we are going to speak about budgeting, and that would be like a budgeting tool. Like maybe that's a criteria you have in a business. I mean, it's a valid criteria. I think you will use it inside a budget construction. Maybe you have as a general criteria inside your treasury department that you need to pay the short-term liabilities with the short-term revenues on the sales, and the long-term liabilities with the long-term revenue from the sales. It could be a criteria for budget practice. Yes, it could be. But
Okay.
right now for the part we are right now, in the cash flow, you are reporting the cash flow. So you are reporting what already happened, not taking any considerations for what are you going to do in the future. So because no one is, so I don't know if that answers your question, Jesus.
Yeah, I didn't notice that. I mean, you got a point. You're right.
Okay, but we are gonna see it. Actually, we're gonna see it today, so don't worry. And nobody's it's volunteering to show their screen, so I'm gonna pick someone. What about you, Jesus? Because you seem to want to participate.
I do, but I'm actually on the phone. So I mean, no, I'm not on the phone. I don't want to lie, but I don't want to share the screen because I haven't done it yet. Just let me do it, and I want to see somebody else do it because I want to, like, you know, get in.
Okay.
I haven't get to do it, so.
Who wants to do it? Because it's not gonna be any fun if nobody shares their screen. We're gonna all fall asleep. Pablo, what about you?
Yeah, I wasn't really sure how to do it. Like I tried, but I am honestly very bad at all these things with finance, so I didn't really understand.
But do you want to share so we can help you?
Well, I haven't completed practically anything, so I think it would be better. I mean, if you want, I can share it, but the format is empty, so I feel it would be more efficient to see somebody else.
Don't worry, someone else. Who else? I mean, it doesn't matter if you don't have it complete right now. We are working to complete it. So who wants to share their screen?
I did share it, but I'm not sure if it. Oh, I'm not really good at finance either, but I can share it too.
Yes, do it, please. Thank you, Roberto. Right?
Yes.
You share it, and I'm going to. Well, we are all going to help you.
All right, I'll share it, but I don't have anything, so don't.
I think Roberto is already sharing, right? I gave you sharing permissions, so
I don't have the permissions yet.
Well, as I told you, the internet's a bit bad today. Oh, it's there. So great. You have right now your cash flow. Okay. So what we need to do is to start with the sales revenue. So you need to put there the sales that you know you are going to collect in that period. We know that we don't have client accounts, so everything that we sell in the period is the same that we collect in cash. So what is the number exactly? That's the number you put in.
Is it this one?
Yeah, it's pretty easy. All right, now we have the sales on cash, and you, okay, drag it to the right. And now we have the sale, we need to write down the sales cost also on cash. And again, we don't have in this example vendor accounts. So everything that we consume in 1 month, we paid in that month. So where would you get the sales cost amount? Someone wants to help us? Nayeli, Maria, Majo, Valeria, Ana Teresa, Andrea, Andres. What?
I said from the income statement.
From the income statement, you are absolutely correct. And he already did it. Okay, perfect. I think I have a lag in my computer. So anyway, the next one is the expense, the operating expenses. And again, the only tricky part here is that you don't need to take into consideration the depreciation, but you also take it from the income statement, all the information. Remember, income statement. And the tricky part is you don't take the depreciation. So is he correct, everyone?
I just have to write the depreciation, right?
Exactly. I mean, you did that, that's okay, but you could also just have summarized all the expenses but the depreciation, and that would have been also correct. Yeah, it's the same.
Okay.
And finally, we'll click enter, please. And the last one is the tax paid. And again, tax paid are a cash expense. So what do you do?
The income statement, right? So this one?
Taxes, taxes, taxes. Yep. Okay, so what happened? And drag it to the right. Now, because even though they are different reporting methods, you should have the same operating cash generated in both of the methods. So what is your cash generated in the other method? Could you please go scroll up a bit? You scroll up to the other cash flow so we can see there. So operating activities, look at it. How much money is that? 67,000, right? So we should have the same amount in this other method. So go down and you have 460,017 pesos with 61 cents. Why? Who wants to help us? What are we doing wrong?
Because the sales revenue is in positive, but the cost and all the expenses are supposed to be negative, but we're summing them
Exactly.
instead of resting them.
Yep, that's the reason. And yeah. Done. And spread that drag that formula to the right so you can have the same in each period.
Teacher, I'm sorry, can you repeat that you just said? I didn't quite understand.
I said that he was all right to drag the formula to the right.
No, but do we put it in negative?
Yeah, that was Jesus. Jesus told us that because we were adding everything up and we needed to subtract from the sales revenue all the cost, expenses, and taxes. So we put it negative.
Okay.
Mm-hmm.
Yeah,
great.
Thank you.
Perfect. You did perfect, Roberto. Thank you.
Thank you, teacher.
So, the investing activities. Now, again, it's the same as the operating activities, like in the sense that you need to know where are you spending the money and you write down the inflow or outflow of money. If you sell assets, if you are selling your assets, then you get more money. If you are purchasing your assets, then you get less money. Really easy, really simple. Here you don't do that thing that we did last class where you subtract one period to the other. In this type of method, you are supposed to know where you sold the asset or where you bought the new asset. Okay, let's see it inside the case. So these are the same numbers that you have. So if you actually just follow me in the presentation, you can do it now. So what you need to do is find the period where you do the investment on the assets, or where you do the investment on assets or the sale on assets. In this example, it's in this period, and I know because we've been seeing the balance sheet, so I know the money is here. I know that I did an investment on 100,000 pesos here because I can see at the balance sheet. So if you don't have a balance sheet, how will you build this part of the direct cash flow? Well, what you actually do, you will look at the capital expenditure or investment budget, and inside that budget, you will see where and when and for how much you did the investment on assets during the previous year or previous quarter or whatever time frame you are analyzing. And the idea is that you actually just write here. You don't do difference here. You do write down the information inside the cash flow because it's either an outflow or an inflow. All right. Is that clear? Are you following me? So who wants to share his or her screen? What about Elliot? Do you want to share your screen to show us the investing activities?
¿Alguien escucha algo o solo soy yo?
Yo tampoco. Creo
Sí,
que
a
sí está
todos, a
trabajando.
todos les está trabajando.
Hello. Hola.
Teacher,
Entonces,
Hola. 1, 2, 3 probando. Hola.
Hola.
hola, profe, aquí andamos.
Se cortó cañón. ¿Dónde me quedé?
La verdad no le escuchamos nada antes.
What part you didn't listen? Like from
When you
here,
were
Híjole.
showing, no, the other one.
here?
When you were in the balance sheet,
This one,
the other
right?
one. Yeah, that one.
Okay, so I'm gonna repeat it again. Please send me a remind if that happens. I'm gonna open remind in my computer. You don't have remind. We don't have remind here, of course. Send me an
No,
email.
but we can write it here in the chat.
No, but it disconnects me, so I cannot see it.
Entonces no sé.
So,
Do we have a remind?
no, we don't have remind. We'll do that later. Anyway, we have a Discord account actually. We should use that one. Well, don't worry. If it happens again, I will send you an email. I don't know what we will do. Maybe I will record the session and then share it with you on YouTube or something. Let's try to continue. It's my internet. I know. I mean, in the morning class, it gave me a lot of trouble, but at the end, it just like stabilized and it worked. So let's try to keep moving. All right, guys. Are you listening to me?
Yeah.
It is.
Okay, so I was telling you that the difference between the direct and indirect method when you are talking about investing activities is that in the indirect method, you go to the balance sheet and then you look for the difference on assets, all right? That's the way to find it. In the direct method, what you actually need to do is that you need to find out where and by how much the assets were spent, all right? When the investment on assets or the sale of the assets took place. Okay, so in this example, I know that I spent 100,000 pesos in this particular period, and I can see it inside the balance sheet. So I take that amount and I write it down my direct method, investing activity, inside the cash flow. Okay. So how will you do it right now? Well, just look at the balance sheet or even look at the cash flow we already built and just copy the value and that's it. That's how you do it. The complication comes when you are building a direct method cash flow and you don't have the income or balance sheet statements because you need to take that information from the CapEx budget. That is the investment on assets budget of the company. I need you to tell me if you are listening at me like constantly because I have no idea.
Yeah.
Okay, so that's it. Who wants to share her or his screen to see how to do it?
Sorry, I have a question. Where did you get that number from? Because in the balance sheet it says
Which number?
150,000, and in the assets bought on cash it says another number.
It does.
So
it says 100. Where it says another number, I have 100,000 here.
yeah. Well, that 100,000 you get it from the furniture and restaurant equipment?
Yes.
Or where do you get it from?
From the furniture and restaurant equipment.
And why does furniture and restaurant equipment says 750,000? Wait, yes.
750,000.
So why is not the same number? I don't get that.
Well, because I am not reporting the amount of assets that I have. What I'm reporting is the investment I did on those assets. And I did an investment of 100,000. And if you see here and you remember the indirect method, these assets change, they increase by 100,000.
Okay.
So that's this number here.
Okay.
But when it says on cash, it doesn't literally mean that they were bought on cash, right?
Well, in this example, it does, but yes, in other companies, it could mean that you don't necessarily did the investment on assets on cash. Yes, that can happen. But in this example, you are paying them on cash.
Okay.
Mhm.
If you want, I can share my screen so we can do the exercise.
Yes, please. Who is asking for
Elliot.
it? Elliot. Okay, Elliot.
Yes. Give me a second.
Elliot. Okay, floor is yours, Elliot.
Okay, thank you.
So, show us.
Yeah.
How would you find the investment?
Which one? This one?
The investment, yes, the investment on assets or the sale of assets.
Okay, these two. Well, assets bought on cash.
Well, what you can actually do, because you have the financial statements, you could go to the either balance sheet or even cash flow and see where and when you did that investment.
Okay, so here in the balance sheet, I have
short-term assets. We are talking about CapEx, which means you need to look for fixed assets.
Yes, yeah, so it will be,
yes.
I will take the total.
Not the total, because that is something you will need to do. We were working on the indirect method. The direct method implies that you need to analyze the information and then identify the investment on assets. So you are in the right place, but you don't need to see the total. You need to see the value of each asset.
Okay, so
I have 1 million, 1 million,
1 million, 1.5, and 750, yes.
Okay, so and then just go to the next period and it says the same values. Next period the same, next the same, next the same. Oh, difference.
Here it changes.
Yeah.
It changes there, and in the next one also, you see.
Also, yes.
And then it remains the same.
Yep.
Okay. So now, because this is a direct method, you need to know if these were paid on cash. So go up to the cash flow. I mean, to the balance, to the cash on balance.
Mm-hmm.
No, in the balance sheet.
Oh, okay, sorry.
The cash balance, and you see how you see it going down.
Here it is.
It goes down, right?
Yes.
Okay, so we could like reasonably suggest that there was a buyout of assets there because our asset account is increasing and because our cash account is decreasing. So we are gonna take the investment on assets as cash. All right.
But
how much is the investment on assets?
Here the difference is like 100,000, and here the difference is like just 35,000.
Yes, because there you also have inflow cash from operating activities. What I'm trying to teach you now is that when you are doing the direct method, you cannot just look at difference. You need to see a lot of information. All right.
Okay.
So if we were only to keep, I mean, if we were only to do the analysis with the difference on assets, then we are assuming that they were paid on cash, and maybe they weren't. All right. So one idea is let's look at the cash flow, and the cash flow is actually reducing, and it's reducing more in those 2 months that it was reducing in the other months. In the other months was increasing. You see, in the previous months on that, from 30,000 to 72,000 to 124. Yes. So it was, even though you have input on operating cash flow in those months there, you have a decrement on cash flow. And then again, once you do the investment, it goes up again. You see the 279 and
yes,
and 334. So we can assume that the difference on cash, it doesn't come from operating because operation remains the same. It should come from somewhere else. So my logic tells me it comes from investment on assets. And then I go to the asset account and I am seeing that there is an increment on assets on those months. You see?
Yeah, yes.
So that's all the reasoning you need to do, like when you are doing the direct method. I mean, it's easier in the sense that if you have the information, you just need to just put it down. But you need to have the information. You need to reason the information. So anyway, we know it's 100,000. So let's write it down in the cash flow.
Right here.
No, it's in the period where the asset increases. So it's
Is this one?
It's that one and the other one. 850 and 950.
Yeah. So
Just
it
write
would be-
down the one. What was the investment on assets? It's 100,000. So you here do write down 100,000.
And also here. It's positive, right? Because it
Is it?
increases.
It's positive if you are selling assets and now you have more cash. But we actually saw the cash on banks and the cash decreased. So I think it's actually negative.
Okay, yeah, because you spend money to buy
You
it.
spend it,
Right.
exactly. So now you may be thinking, but teacher, it doesn't have a formula. No, it doesn't. In the direct method, more often than not, you actually will need to write down the information. Okay.
But you can do it if you
Yes,
choose
you can
like
formulate it, of course. I mean, but you, as I told you before, you need to take in consideration more information, not only the difference between accounts.
okay.
Okay, so that's okay. That's great, Elliot. You did it right. So let's go up to the cash flow for our indirect method and let's see. The
Oh,
cash flow from
sure.
last class, and tell me how much. What was your cash flow generating from investing activities? So your cash flow from investing activities is minus 100,000. You see it in line 91.
91. Okay, yeah, the total, yes.
So as we saw with Roberto, you need to have the same value in your new cash flow. So let's go down and you have 100,000 negative. So great, we are doing great. Okay?
Okay.
Perfect. Thank you, Elliot.
No, you're welcome.
So let me share now my screen and let's continue. Okay, now let's see the financing activities. And again, you need to identify what are the outflows and inflows of cash directly inside the cash flow. You can do it also analyzing the previous income and the previous balance sheet. What is more common that companies have debt budgets, like financing budgets, and they actually recognize the inflows of cash when they hire new debt or get new capital investment inside the cash flow, or they withdraw from the cash flow the money when they are doing capital reimbursements or when they are paying capital or debt. Okay, so again, it's just really simple. If you pay your loan, then you have less money on your bank account. Basically that. And again, I go to my balance sheet and I see the information that I have for liabilities, and I see that I have family loan of 120,000 pesos. And this one remains the same always. But when I go to the mortgage, I am seeing the mortgage is being reduced. And maybe here I have my mortgage agreement, my contract, and in the mortgage say that I need to pay on cash every month 25,000 pesos, which is actually the difference between these two, 25,000 pesos. So I know I need to pay that. So what I will do is I will just write it down inside my liabilities paid inside the cash flow statement. Okay. Again, really easy. You just look for the information. In this case, we have the information because of the because we have the financial statements, and because we know that we pay that mortgage every month. If you didn't have financial statements, what you need to do is that you need to recollect the information of debts, debt outstanding, debt to be higher, future capital investments. I mean, not capex investment, but for financial funds investments. That's what I mean, from issuing stocks and all of that. So that's how you find it in the direct method. Is that clear, guys? Or my audio got again?
No, clear.
Okay, so who wants to share the screen? What about Sebastián Domínguez? My guess is no. Maria Georgina?
Yeah, sure, I can do it.
Okay, let
Can
me
you
give
make
you
me
permission.
co-host?
Yeah. Wait a second. Okay.
So I already done it, kind of.
Perfect.
But where I found the difference was in the mortgage as well.
Yes.
And it was 2,500,000, sorry.
Okay.
But I don't know if it's positive or negative.
Well, you are paying a debt, and if you are paying something, it represents a cash outflow.
Okay,
So,
yeah,
will it be positive or negative?
negative.
Okay, negative. Okay, right. So, drag it to the right, and then let's do in your computer the final part to see if we are correct. So, in the cash generated in the period line, the 117, add up all the cash generated from operating activities, financing activities, and investing activities. Okay, that one plus
That one and
that
plus
one, yes, plus
that one.
that one, yes, and then take the cash at the beginning of the period, which is
Oh.
actually the previous. Again, like you did in the other cash flow, it's the previous balance of cash inside the balance sheet.
Okay.
So the previous balance of cash. So go up to the cash balance, and the previous balance is.
Oh, how can I see it?
Cash and cash equivalents.
Oh, okay.
That's your previous balance, yes.
True.
And then you just add those two.
Okay.
In the last one, and just drag it to the right, and you should have the same result here as you did in the last one. So I can see the 98 line. You have 72,000, 72,000 here. That's correct. 187, 187, 302, 302. So it's correct. You did it right.
Yeah,
You see?
correct.
So thank you, Maria. And as you all can see, it's the same. It's the same answer that you will end up with. Okay. So you already did that, and that's what you end up with the cash flow. And the question will be: is there any difference in the result of the methods? Well, the answer is no. You will end up with the same amount result in both of the methods. The difference is how you get to that result. And again, just look at these two and tell me which one will be easier to analyze looking for the cost of the company.
Sorry, can you repeat the question?
Which one of these two cash flow statements will be easier to analyze if we are looking for the cost of the company?
Well, I would assume that the indirect method, right?
Okay, so tell me where I can find the cost, the product cost here in the indirect method. This one is the indirect method.
Where you can find what, sorry?
The cost, because I want to analyze the cost of production. So you say the indirect method. So where do I find the cost of production in the indirect method?
That is a very good question.
The direct method?
The direct method. So where can I find the cost of production in the direct method? Here, it's listed there, right there in front of us, all right? So when you are doing operating analysis, it is easier to have a direct method cash flow. When you are only reporting the flows of cash, it's easier to just have the indirect method cash flow, all right?
Okay.
And again, this method is actually preferred by the FASB. That's the International Financial Accounting Standards Board. Why is it the preferred method? Because just as you saw here, if I want to do an analysis like auditing the cash flow of the company, it is easier to find a specific cash account inside the direct method that is to find in the indirect method. Now, it is preferred, but it's not mandatory. Most companies to report the financial statements in the stock exchange, if not all of them, use the indirect method. And why is that? Well, because this method requires an extreme amount of detail of the information. You actually need to know really detailed information on the expense and cost object of the company, and you need to know that month by month. So it's really difficult to keep track of that, even year by year. That's why most of the companies opt to use the other indirect method. This method is mainly used in the construction of the cash flow budget for the master budget. So that's why we close with this one, because we are going to start seeing budget information. I'm going to introduce you guys to budgeting in corporate finance, and you'll see why and then you will build your budget for cash flow budget, and also your income, your operating budget, and your investing budget. Key notes for the cash flow. First off, remember to always only use cash. In any of the two methods, always think that you are looking at cash going in and outside the company. Second, you need to take into consideration the CapEx investment. CapEx means capital expenditure, and you need to have that there because it actually drives sometimes the decision of the company, and it moves the cash flow in important ways. From an operating analysis, analyzing the cash flow, it's always better than analyzing the income statement, because in the cash flow, you actually see how much money you're going to get paid. And if you use a direct method of analysis inside the cash flow when you are budgeting, it is easier for you to actually set goals and analyze the company. And it helps you also when you have like a plan and like a master budget, and you have already set different objectives and goals. It helps you keep track of them and also see if you are going to lose or generate money with your plan. So those are the key methods of the cash flow. And just to close with the same analysis we've been doing on this presentation, this is the cash flow from Amazon. Again, you can find, even though we did a really easy and simple analysis on the exercise, we can apply that information here, that analysis here, and I can find the operating activities here, I have the investing activities here, and I have the financing activities here, and I have my cash flow generated at the end of the period. You see? So tell me, who can tell me which type of cash flow this is? Is it the indirect method or is it the direct method?
The indirect.
Why you say is you say what? Direct or indirect?
The indirect.
Why, Carla, you say it's the indirect?
Because at the beginning, in operating activities,
David.
You're using the net profit. And
yes, exactly. That's one reason, because you start with a net income and then you add and subtract the difference on operating activities and investment. And look at this, it says changes in operating assets and liabilities. You see? It looks at changes in the assets, in the accounts on the balance sheet. And thank you, Carla, you are correct. And analyzing the cash flow, we can actually see that Amazon, it's a juggernaut to generate sales and cash from sales. The operating activities generate a lot of cash. And what do they do with that cash? Well, they actually reinvest a lot of cash in what? In assets, purchase of a property, plant, and equipment. They are building the Amazon warehouses and distribution centers. And if this money is not enough, because if you can see here, Amazon generated $80,000 million in cash flow from operations, that is sales and services. We spent $27 million on investment on assets. So from where did Amazon got the difference to invest that kind of money if it didn't take it from the sales?
From loans.
And why do you say that, Elliot?
Well, because for example, it says proceeds from property and equipment incentives, acquisitions.
Yes, exactly. But this one is important. Proceeds from long-term debt. The difference comes, thank you, Elliot, just as Elliot said, from this, they hire a lot of debt. So now we know that Amazon, it has stopped taking investment. And why is that? Well, most likely because the weighted average cost of capital of Amazon from their equity just increased a lot because it's a really profitable company. And for them now it's more expensive to take out shares and raise capital, that is to hire a loan. That would be the reason actually. So it's really interesting to understand this because now you can analyze companies really into detail. All right. So anyone wants to say something else here before we close this part of the class? No.
Teacher, I had a question in the Excel, almost in the last part, when we put the cash generated in the period. Did we sum the three parts? Cash flow from operating activities, investing activities, and financing activities?
Yes.
Okay.
You are out this one, and this one. And this one will give you this one here.
Okay.
Okay.
Thank you.
And it's the same for Amazon, and it's the same for the example I gave you. So now you can analyze financial statement for huge companies. So we review what are the financial statements. Financial statements. We did that. We review the cash flow in detail. We know now you know how to build a cash flow in the indirect method, and you also know how to build it in the direct method. So I say this class was a success. Okay, so let's now go to the second part of this week, which is budgeting. Okay, now we are going to talk about budgets. Budgets in corporate finance. What are we going to see in this class? We're going to see introduction to budgets, objectives, basic elements of budgets, the impact the budgets have, and we are going to start introducing the master budget, and we are going to stop there. We are going to reach the master budget and see it on detail the next class, because that's going to be our introduction for the budgets you need to work on. And I'm going to explain you the homework you need to work on during the weekend, and you need to present that homework on Monday, okay? So let's start. Let's start with this. Budget analysis, it's really important on any organization. You can find it in churches. Here in Mexico, church parish are actually registered as companies. They are called AR, that is Asociación Religiosa. You can also find it in ONGs. In Mexico, they are called, they are called ACs, that is Asociaciones Civiles. You can find budgets in companies, that is SAs, SSS, SDRL, whatever. And you can also find it in person, that is people like you and me. Budget is really important for planning. And please open your microphone and tell me what other organizations you think may need a budget. What other type of organization?
Construction.
Well, construction will be a company here, right? What I mean is like, what other type of organization that I'm not writing here do you think might use budgets? What about the government? Do you think the government needs a budget or uses a budget?
Yes, definitely.
It uses a budget. It's actually, here in Mexico, it's a law. It's called La Ley de Ingresos de la Federación. And for the government to work the next year, it has the Treasury Secretary needs to present a budget, and that budget needs to be approved by the lower house, that is the Congress. And then the Congress sends it to the Senate, and the Senate issues the law, the budget as law, and the government should comply to that budget it presented the executive branch. So it's that important that it's actually a law, and if the law is not complied, then the executive branch in theory gets in a lot of trouble, because again it has to go through the legislative process to approve a new budget or budget changes. That's actually something that happened to this government this year because of the COVID crisis that impacted the finance of the government. Okay, so yeah, that's an organization. When you are creating a budget, what you do actually is that you establish goals, you give tracking of plans of projects that you have, and also you work to compare the results and the goals that you have. The budget analysis and the creation of a budget per se, it's actually a really managerial accounting and managerial level finance task. That's related with the administrative process. And Reyes Ponce is the most known author for administrative methodology and analysis in Latin America. So these are the 6 steps or administrative process that Reyes Ponce put forward. That is, you need to forecast, plan, organize, integrate, direct, and control. And in which of these steps do you think budgeting takes place? I mean, budgeting will be in everything, right? But in which one do you think it's like predominantly taking place, the budgeting tasks?
Planning.
Planning will be one. Which one? Which other one?
Integration? Maybe forecast,
integration.
right?
What?
Forecast, maybe? Because you
Maybe
need to make
forecast.
all those calculations.
Maybe organization. Maybe directing, maybe control, right? Well, you are not completely incorrect. Forecast is not a budget. Let's be clear on that. Actually, you need to do a homework on that. It's a video you need to watch. Then I forgot. Now we're gonna do an activity. So we're gonna go to modules and we're gonna watch a video for this session, all right? It's this video, and then we're gonna discuss. And now that we are thinking that maybe budgets are related with forecasts, this is going to take even more weight on our analysis. So let me know if you can see my video, please. The video on my computer. Just 5 minutes, we're gonna watch the video and then we're gonna discuss it, all right? Are you watching the video? Does it work?
Yes.
Success requires both effective budgeting and forecasting. Budgeting and forecasting are not interchangeable. Each has a distinct purpose. A budget details expected future results. It is a definitive statement of expected sales volume and operational production capacity, as well as revenue and profit streams. Budgeting is a coordinated effort across the organization to optimize allocation of scarce resources to most efficiently achieve the organization's mission and objectives. Forecasts are predictions that focus on probable future events upon which budgets are based. The sales forecast is the initial and most critical step in forecasting an organization's future performance. All other forecasts are dependent on the accuracy of the sales forecast. The sales forecast identifies future probabilities or expectations from the marketplace. It consists of sales revenue, sales volume, anticipated cost, and profit contributions or margins. Forecasts utilize historical data, statistical analysis, expert opinion, and other references to improve accuracy and inclusiveness. A budget is similar to the flight plan for a plane, a detailed map of where the organization intends to be at any given point and what it needs to reach those objectives. The actual performance and updates to the forecasts are like the air traffic controller, guiding the organization to either stay the course or change direction based on the data. Budgets and forecasts can be both short-term, or less than 1 year, as well as long-term, or over multiple years. Forecasts are only valid as long as the data and assumptions used to create them remain valid. Because of the dependence on variables and trends, no forecast is ever 100% correct. But continued analysis and recalculations allow forecasts to be as accurate as possible. With easily accessed real-time data, many organizations are now better equipped to keep forecasts current, as well as make risk assessments based on those forecasts. Managers can then accommodate changes in the forecast by adjusting both planned performance and forecast assumptions to better avoid potential crises. Let's look at an example. Jane is the senior sales manager at a global company. She is preparing her monthly sales reports to assess how well her department is meeting its quarterly performance goals as set by the company's annual budget. To assess current performance and forecast the department's likelihood of meeting its targets, Jane asks regional sales managers to provide current sales information that includes past and projected sales by product line, changes in the spending habits of key customers, inventory levels, and pressures from competitors. During her analysis, Jane identifies 2 key products with the highest profit margin contribution are over 20% behind the sales forecast. A competitor has also entered the market with a similar product priced 10% lower. Additionally, inventory levels of those products have risen by 25%, causing operational issues and costs. The cascading effect of these changes to the forecast will have a serious impact on both the sales budget and the operational budget. Jane and her managers decide to take an aggressive approach to address the issue. They devise a multi-phased plan of response, beginning with a sales blitz, assigning additional sales personnel to key customers, and offering current quarter discounts on inventories on hand, a one-time 15% price reduction for this quarter. To counter competitive pressures, Jane and her team authorize a print advertising campaign, emphasizing the advantages of their products. Finally, they initiate a targeted sales campaign to promote those 2 key products to major customers, offering volume discounts and free shipping. By using the combination of the organization's sales budget and her forecast of likely future performance, Jane is able to adjust her sales expectation response and increase the likelihood that organizational performance goals are achieved. Without updates, Jane would not be aware of major changes to the forecast and subsequent budgets. Budgets and forecasts are not one-time financial exercises, but a day-to-day reference that enables organizations to ensure their future performance. As such, continuous improvement is the key to accuracy.
Okay, so that's a video from Accenture. Accenture is actually a really huge company for financial analysis. Let's now talk a little bit, right? So let me see if in my video now it's working. So no, it's not working.
Yeah, I think not.
Yes, it is working.
No, I'm not moving. I mean, I get stuck. You see?
Yeah.
So it's gonna, well, anyway, so everyone open your microphones, please, if you will. And let's talk about the video. What do you think is the reason for the difference between a forecast and a budget? What do you think that is?
Well, I think that a forecast is much less based on the company's internal resources. It's more on external factors, more like economic factors and possible outcomes of the market. And the budget bases itself on these forecasts, and it uses their resources and moves them in order for them to achieve their goals more efficiently.
All right, nice, really nice explanation of the difference. And of course, I will take here maybe that the forecast also takes like a greater period of time, right? It's like a longer time frame.
Yeah, of course, the budget is it's changed more frequently because it should change with the company's goals and objectives, and the forecast is more long-term based on the external environment.
Great. Who else agrees with that or disagrees and wants to say something? Alejandro, Carla, Eduardo, Constanza.
I agree. I also think that the main difference is that based on a forecast, you plan your budgets as a company.
Great. Yes, based on the forecast, just as Pablo was saying, the forecast is like you could actually think it like your mission, right? We are going to do this in the long term, and my vision is how I'm going to do it. That is the budget. Yeah. So second question, do you think the exercise of budgeting operations, sales, or investment is useful for a company, or is just like a useless exercise, just waste of time? Emiliano, Andres, Sebastián, Ana Teresa, Majo, Val, Elliot. What do you guys think?
Well, I believe it's very important because if there's no, if the budget is not right calculated, then it will be very problems in the long term. And if there's no communication between the forecast and the budget, maybe the company in the long term they will struggle with the numbers, getting more inventory than it's needed, and the forecast is not like saying one thing, but the supplier is doing another.
Yes, of course. Great. So you think like for control it's really important, right?
Yes, actually, I used to work on a restaurant, and I think that the most important use for the budget and the forecast in regards to the restaurant was the inventory control and all the all the inventory control and things like that. Because if we got more food than we needed, then it goes bad and things like that.
Wow, so also for planning purchasing, you use the budget.
Exactly.
Okay, great. Thank you, Eduardo. So we all agree it's really important for a company, right, to have a budget and do budget exercises.
Yes.
Okay.
Yes.
So let's go back to the presentation. Okay. There. So with that in mind, what are the three aspects that we are actually more related with budget and with the budgeting process, like on day-to-day basis on a continuous exercise? Well, you will have planning, directing, and controlling. Forecasting, no, because forecasting, as we saw, it's not the same. Budgets are planned and forecasting, but budget do not change the forecast like continuously. So we will start with planning because, well, the company's goals are set in the planning, analysis, and activities. Then, of course, directing, because leading the company and taking the decisions needs to have like some sort of assigning responsibilities. And using a budget actually helps with that, because with the budget, you say, this is the money you need to spend. Like Sebastian, I think what Sebastian was saying inside the restaurant, when you have a budget of food that you need to purchase and use, if you don't do it like in the time frame that you establish in the budget, well, you are responsible for that wasted food, right? So that's part of directing. And controlling, of course, because it helps you once you have the assigned responsibility, and again with the example of the food, it helps you control if this time of year you actually bought more food of what you needed, well, you will adjust and control the next purchase of raw materials for the restaurant. I mean, I think I'm understanding correctly. I don't know if I'm understanding correctly that budget inside a restaurant. I never work with restaurants. I think they're really difficult. In my company, we don't do analysis or take restaurant business because of the complexity of the business. Even if it is a small restaurant, it gets too complex too fast. Okay, so if you see it inside the analysis and the administrative process, you have planning, directing, and controlling, and the feedback is actually the budget. All right, the using the budget helps you give feedback to the administrative process and change things in case you are not getting the results that you thought you were going to get. Okay. I'm sorry, it's like I'm talking for too long. Okay, so now let's see what is the impact a budget has in the human behavior and the impact on a budget. All right. So in general terms, when you read about budgeting, you're gonna find three things that are actually a lot of that you will find on all of those finance articles that agree on, and that is that there are three things or three three stages of budgeting that are actually will change the outcome or feasibility of the budget in relationship with the human factor. That is, what if the budgets are too tight, too strict, and therefore too difficult or impossible to achieve? What will happen there? What if the budget targets are too ambiguous, flexible, and they are too easy to achieve? What will happen there? And what if the budget goals conflict with the company and the employee goals? What happens if there is a conflict of interest? What will happen to the budget, and also what will happen to the company? Let's illustrate with a diagram, really, really easy and fast. If the budget is too tight, then you cannot accomplish it. If the budget is too easy or too loose, then it is extremely easy to accomplish. And if there is a conflict, then you shouldn't try to accomplish that objective, all right? So when the budget is too strict, too tight to accomplish, the negative effect accepted upon that is that it will have a negative effect on the motivation of the employees, all right? If the goal is too strict, then the employees cannot reach it, and if they cannot reach it, then the team gets demotivated, and if you are not motivated, then you don't work as good as if you are motivated. So for this reason, what is the solution? Well, it's to include everyone, or try to include everyone as much as possible in the budget process, all right? Giving them a sense of control of the process and also of the task. That way the employees will get committed with the goals and will work more to build and actually accomplish the budget goals. Guys, I'm feeling I'm speaking too fast, I'm going too fast, so I don't know if you are listening to me. If I'm going too fast, okay, please interrupt me so I can repeat myself. Okay? Okay?
Yes, teacher.
Yes, I think we are going well.
So what is the next one? Well, the next one is if you have any trouble. If you have troubles, you could have troubles if the budget is too flexible. That's also not desirable, because if it is too easy to accomplish, then it creates a budget padding, all right? And that budget padding is actually called budget slack, like in terminology. And what that means is that the managers or employees, what they end up doing is that they generate budgets with lower expectations, thinking that they will actually go ahead and maybe accomplish them easier. And when they do that, they actually generate inefficiency inside the company. And one example of this is actually and again, let's retake the example of the Ley Ingresos de la Federación, which is the budget for the country for every year. And the previous government, Enrique Peña Nieto's government, what they used to do it's something really, really corrupt. And when you think about it, a little bit fun. But I'm an accountant, and I was studying my master's degree on taxation when this was happening. So I remember my public finance classes. There we were analyzing financial statement for states, for public-owned companies, and also for the federation secretaries, departments, I'm sorry. And one thing that we saw a lot is that for almost every year of Enrique Peña Nieto's tenure, the budget for the next year was always like under budgeted. That is that you always had like a sobre ejercicio. Each year, the government will say that they will get like 5 billion pesos in tax revenue, and they will end up getting like 5.5 billion pesos, you know? And then they will just parade that as an accomplishment and efficiency in the government. But that happened every year, you know? And I remember in my public finance class, the teacher was like an old politician from the pre-party. And he was telling us the reason why they are doing that is because that extra money that they get, that they didn't budget it, is actually a discretionary amount that the executive branch can spend as they please. And they don't need to go to the legislative process to actually distribute that money between the states or between other dependencies. And it's just something that generates a lot of inefficiency inside the government. And that's an example of really easy to attain goals, you know, and it can happen in the huge companies or the huge governments like the Mexico's government. So that's an example. Next one is conflicting budget targets. That is when you have a goal or a target that actually it's conflicting with the company's or employees' interests. That it doesn't. What happens here is that maybe the management team has an idea or a goal that it wants to reach, and it sets the employees to that goal. And maybe the goal is attainable. Maybe the goal will actually create like some sort of work and work over efficient inside the company. but maybe that goal it's not morally acceptable. Maybe it has a problem, and maybe it shouldn't be pursued. And it sounds more like a ethics question or moral question, but it's actually really important to take that in consideration in a budgeting process because it can kill businesses. Think about Enron, think about Wells Fargo, think about the crisis, the 2008 crisis, and to work on this, because this is really important and I need you guys to take this really into consideration, we are going to do an activity. So we have 50 minutes to do that. So please go to your internet browser and write Yogame fraud, okay? And tell me what you find. You can write it in Spanish actually also, Yogame fraude, and read some news. Who is already looking for that information? Who can tell me something that they already found? So go to your browser, write Yogame fraud or Yogame fraude or fraude Yogame. So I'm already seeing the first one says this startup raised $30 million. Now its founder is accused. Ahí se gastó el presunto fraude de la startup Yogame. Months after raising 25 million, education startup Yogame shuts down. Mexican edtech startup Yogame shooters due to fraud. Who wants to read one of the news?
I'm still reading, but it apparently says that accordingly to employees of the company, this company is going to close because supposedly bad management of the CEO and founder Manolo Diaz.
Mm-hmm. And you or someone else has found something about the numbers and what they were doing, changing and manipulating the reports presented to investors?
Yeah, I just found in Forbes that apparently they achieved like having $30 million, but they don't know how clearly that money was destinated. And apparently they received an investment, of $9.5 million as well. But between 2013 and 2017, but it doesn't say like it says levantamientos.
Mm-hmm. Raising capital.
Yeah. And that's the only thing I found.
You found that. So thank you all, Elliot and you, and thank you for reading that aloud. Well, this is a company, and it's actually really interesting because this is a company formed and founded by Exatex. It's actually one of the two startups, the first two startups to be in Latin America, not in Mexico, in Latin America, to be accepted into an acceleration program in the United States, in Silicon Valley. They were accepted in 500 startup. They, another company called Contacto. And they were by a lot the most successful startup in that program because I think it's like 5,000%, something like that, return it generated to 500 startup when they sold the company to Sequoia Capital. I think is the one that actually bought the first round. And they just kept raising capital. And these companies, they are Exatex, unfortunately, and they were the proud of Exatec. When you were starting a company in tech as part of the entrepreneur system, they will tell you about these guys. And actually, I went to Silicon Valley, and Manoli is the one wearing the blue shirt. He gave us a talk about raising capital and getting inside the startup environment in Silicon Valley. And I remember he told us that sometimes the startup needs to appeal to investors, like that it's more about appealing to investors than to getting to the results fast. And now looking in retrospective, what he was telling us was that he was actually lying to the investors to get the investment. So that can happen. This was a promised unicorn inside Mexico's entrepreneurial startup environment, and now he is looked for fraud, and he just disappeared, Manolo. because he was the one who directed the fraud and actually manipulated the numbers presented to the board of directors and investors. So budgets are really important, and the conflicting objectives of the managerial team that can have a deep impact inside the company. And if you want to learn more about it, you can read more and more about it, and you will find that actually a lot of the employees of Jovome, when this thing was when this was taking place, when it was clear that Jovome was a fraud, a lot of the employees started quitting the company and actually denouncing what was happening with the reports and the financial information presented to the investors on Twitter. So it's really, really interesting because you can look for that information and look at the tweets, and the tweets are still there, and you can see it like, you can see it just coming down apart little by little, live with the social media landscape that we have right now. So anyway, that is the last thing about budgets and human behavior. Now it comes down to budget systems, and budget systems, it's really important not only to do a budget exercise, but actually to implement a system. And budgets are actually calculated for fiscal years, and what you can actually, when you calculate a budget, what you do is that you split the budget in shorter time periods, that it's years, months, or weeks. When you have a budget system and you are continuously budgeting 12 months budget, then that is called a continuous budget. That is the most likely budget that you will find in a big company if you end up working in the finance department, because the idea is for the budget to be continuously changed, reviewed, and controlled. So how would you see a continuous budget look like? Well, you have 12 months here. From here to here, these are 12 months. All right. And the idea is that once you have a new month, that is when I go here and I have March 2020 something, the money, then I move my time frame from March to March, right? And that's how you do the continuous budget. You forget that last one, and then you do the next 12 months. And this is actually called in English trail 12 months, like that. You will find the information like that. If you see these letters inside a financial statement, it means that it's a continuous reporting, and it's using this type of reporting standard. That is not fiscal year, but 12-month period, month to month. Okay. So the development of an annual budget usually begins several months before the end of the current year. And I have a question for all of you guys. When do you think January starts the budgeting process? Like, when it's a good time for a company to start budgeting?
Well, I personally believe that the budgeting process should start from the beginning, like even
beginning of the year,
since they start. Like, it's something necessary to have, like, absolutely all the time.
Great answer, Pablo. Who else agrees or disagrees with Pablo?
I would say that they could start after probably they receive enough profit to create a budget. Well, in order to have a more clearer idea of what they expect in the year or in the future years.
Thank you, Andres. Yes, good answer. Who else agrees with Andres that it should start when you are already generating revenues, or disagrees with him? Well, the answer for this is actually that it depends on the company and it depends on the environment. As Pablo just put it, yes, it is. It is, of course, preferable to have a budget system and a budget task in place every moment from the birth of the business to the end. You know, that's the perfect way to run a business. Where budgets are a little bit expensive to run, so it's not used that often. Usually, companies will use it, just as Andres put it, when they have money and when they see the budget as something worthwhile. But the general idea is that it depends on the management team. If the management team says that they actually are seeing like a complex economic environment, then they will start the budget regardless of the time frame they are stepping on. For example, when all this happened, when the COVID crisis started back in February, a lot of my customers start talking to me about what the hell I'm going to do. And my answer was, start budgeting for the worst. Just start budgeting what will happen if you have to pay your employees 3, 4, 6 months and not receive any sales. And let's start looking for cash from government support, from local government, or maybe for loans from local banks. Let's look for everything because it's gonna be heavy and it ended up being really difficult. So again, it depends on the management and the objectives you have, and also on the environment you are setting up. But then I will have to agree with Pablo. The best thing is to try to have it like every time, you know, try to budget the most that you can, and to work on the company, like to absorb that task, like something the company has to do generally day by day.
Yeah, and I also think that it has to do with the actual with the industry in which the company is in, because if it is a very stable and you know, traditional industry, and let's say there is no external threats, then maybe the company can maintain their processes. And if they're not going to invest or make any big changes, then it's not that essential for them to do budgeting. But if it's a very volatile industry that has like a lot of changes, and that there is a lot of difference in the market from one day to another, then it's also very important for them to make the budget. Like, it also depends on the industry, I believe.
Great, and I like your answer more and more. You suggest we do it. We try to do it constantly, but also depends on the budget. Great. Okay. So let's continue. Who are the people who actually build the budget? Well, the budget is usually built by a team inside the company. It's assigned to a treasury, a budget department. It consists of a budget manager, a controller, a treasurer, a production manager, and a sales manager. And why do you have a production manager and a sales manager inside the budget team, the treasury department, I'm sorry? Because you need to budget sales and production, because you need to budget expenditure, cost, raw materials, whatever, and also how much money you're going to be collecting from your sales. Once the budget is done, the process is monitored and summarized by the accounting and finance department inside a company. That department reports to the CFO, and it's the CFO to take the budget to the board. Really important. The budget, it's a board thing decision. It's really top management decisions inside the company. When you work with small businesses, like I do, budgeting, the business owner or the board, it's actually involving in everything, in operation, in sales, in management, in collecting, in accounts payable, in everything it's involved, the business owner. But when you work in a huge company, the budgeting system is actually controlled by a managerial team. It's top tier management level. So it's the CFO actually who is responsible at the end for that budget. And if you get it right, then the CFO and its team gets a bonus. If they get it wrong, then they get a kick in the they get se los regañan. I'm sorry. So what are the budgeting systems that there are over there? There are two main budgeting systems. The first system is a zero-based budgeting system. That is, just start budgeting as if nothing ever happened. You know, even though if you have a history of information, you start right now like with a clean slate. You rebudget the sales, you rebudget the cost, you rebudget everything with the idea of starting again and planning for the future. And the other type of system is the base budget for the previous year. The idea there is that you actually use the information from the previous year to project and budget the next year. And with this approach, we have two types of budget approach. That is a static budget and flexible budget. Remember, two types of cost of budgeting system, zero base or previous year. And then once you choose whichever you're going to use, and you will have a static budget and a flexible budget approach to generate your budget. The static approach is that once you have the budget, it will not change never and ever. You know, you start the year, you say, I'm gonna spend this and I'm gonna collect this, and that's it, period. You know, usually it's large service companies like Ernst & Young, Pricewaterhouse, banks, big companies that use this type of budgets. Government entities also really common that governments have static budgets, and inside a company, specific parts of the company use this type of budgets. Remember, when you are seeing a static budget, it means that it will not change with the activities. And this is an example of a static budget. You have direct labor, electric power, supervisor salaries. The total cost of the department is your budget. And again, budgeting is really simple. It's just writing down the information you're going to be expending. Next is the flexible budget. Guys, again, I'm thinking I'm going too fast. None of you is saying anything, so I guess
we're good.
Jerry, it's okay. Don't worry.
Okay, so next one is flexible budget. Flexible budget, it's again, it will show you the result for the result of the income inflows and outflows of cash. This time is gonna vary depending on the activity. The flexible budget is actually composed of different static budgets with the difference that you will move the budget according with the activity. There are 3 steps to actually generate this budget. The first one is identify the activity levels. That is, how much are you going to sell or produce of each of the products or services. Then identify the variable cost, so you can modify the output of the costs or the revenue of the sales accordingly with activity levels. And last, just prepare the budget, multiplying the unit cost by variable cost and generating the total sales or cost budget. And this is the example. First, you have the activity level, that is the units of production. Then you have the variable cost multiplied by the units of production, that is 8,000 times 5 will give you 40,000, and then times 0.5 will give you 4,000. This will be the variable cost, and then you have the fixed cost over here. You just add them up, and you have the budget for your the flexible budget for the department of company you are working on. Again, it's really easy. It's just you have the things that you're gonna sell, you have the things you're gonna produce. You just multiply by the unit price or cost, and then you have the budget. Again, it needs, if you are working with a flexible budget, it will adjust with the changes in activity levels. How would you see it with images? Well, the flexible budget looks like this. It changes with the units, you know, and at the end you compare with the actual results, and then you get the difference. In this case, it's an under budget because it got lower. We budgeted less of what we actually sold at the end. But if you go to the static budget, you actually got an over budget because you actually sold more of what you budgeted. So that's the difference. The static budget is the same, and you compare the budget, the static budget, to the actual results, and in the flexible budget, you change it month by month, year by year, or period by period, so you can get the closest you can to the actual results. Let's see another example. Let's think of a company that manufactures bags. You have the depreciation cost, you have the labor costs, you know, 1 per table. This is per bag. I'm sorry. You have wages and supervisory, that is 22,000 pesos a month. Then you have 1 hour per bag plus 1,500 per. This is per hour. No, that's correct. That is per bag. I'm sorry. I've been speaking too long. Okay, so that's the information. And then we have the units of production for August. So what we're going to do is we're going to build the budget. So how do you think we are going to build the budget? What is the first step we need to do? Alejandro, there is going to be a homework. So remember to watch the video to see the homework instruction because it's individual and you need to actually deliver it on Monday. So to build the budget, what you will do is you put your units of production, that is your activity level, on top, and then you just multiply that by the unit cost of everything. So this one, for example, was 1 peso, and this one 0.5 pesos. the addition of those two is the direct, I'm sorry. It's the direct variable cost. Then you have the fixed cost here, and the addition of this and this is your budgeted. So it's really simple. Once you have the information, all you need to do is to take it and put it together. So to finish the class today, all of this is taking us to something that is called the master budget. And we're gonna work on building the master budget next week. And I'm gonna tell you what is the master budget comprised of. It's comprised of the operating budget, the investment or CapEx investment budget, and the cash budget. Now, each and every one of these types of budgets is related with one financial statement. So please open your microphones and tell me, which financial statement do you think relates with each type of budget?
Well, with the cash flow, right?
Which one will be the cash flow?
The cash budget, no?
I
The
think the
cash
cash budget.
So that's the cash flow. So
The
which,
operative will be the income statement,
The income statement.
and the investment, the balance sheet.
gosh. You all agree with that?
Yes.
Well, let me tell you, you are absolutely correct. The profit and loss or income statement will be the operating budget, the balance sheet will be the investment budget, and the cash flow will be the cash flow budget. And these two have this mark here because these two are actually part of something that is called financial budget. Don't worry, we're gonna review that next class. And just to finish, remember this is really important. When you are actually projecting financial statements, working on budgets or forecasts, each of the two is the same. The financial statements are no longer called just financial statements. You need to put pro forma financial statement. So the people that is the person or individual or professional that is going to read that information knows that that is not a report of the past. It's actually just a budget, all right? It's budgeted information. It's not based on actual data, okay? Okay, guys?
Okay, yeah.
Okay, yes.
Okay, so just to finish that was the last part of the class. Next class, we're gonna retake the master budget. I'm gonna tell you on detail what is what you expect to have in the financial budget, in the operating budget, and all of that. And then we're gonna work to build the master budget. For next class, I need you guys to actually work on the homework. And what is going to be the homework? Well, right now you should already have read the case. If you haven't, well, you're gonna have to do it during the weekend. You need to read the case, and if you read the case, you're gonna find out that all the paragraphs with informations are numbered. You all guys notice that?
Yes.
That's because each of these paragraphs contains information for generating a budget. So what is going to be your homework about? You need to take all this information and put it inside an Excel spreadsheet in tables. And you're gonna have one table or even a little bit more tables for each of the paragraph. And I'm gonna show you how I did it. It's not for you to copy me, it's just for you to know what you need to do. So I have my sales forecast, my raw materials, my direct costs, my overhead expenses, and I have it here numbered. You see, I know that this is related with paragraph number 10, this is related with paragraph number 9, and so on, all right? So you need to take all the paragraph and turn them into base information to create the budget. These are the budgets we're gonna build next classes. Right now, you need to build this by yourself during the weekend. So do that, download this and build that. Next step, once you are building that, remember, the tables are gonna give you information on time frames. So when you take the information from the tables, remember to put it horizontally, don't put it vertically. For example, the sales information inside the raw case, inside the case, it's this, and you can see these are two tables, vertically tables, you know? So if I only were to put this inside my Excel, you will be correct, but it's gonna be really difficult for you to actually build your financial statement. So work on all the information regarding time frames horizontally, all right? And the example is here. You can see that I have my products X and Y here, and then all I do is just I take the sales data here and I spread it here like a forecast. All right. If you start doing arithmetic formulas inside your Excel spreadsheet, use formulas. Do not write down the information, and as that's going to make it really difficult for you guys to build your financial statements.
Professor, so there is enough information for each paragraph.
Yes, yes, there is enough information. Each paragraph has information to, for example, look, this one says labor force direction being incurred quarterly according. This information is for receivables, all right? This is for how are you going to collect your sales.
Okay.
You see, what else? So the CEO had already this a capex. This is an investment budget. You see, there is a lot of information. Each paragraph has the information.
So each paragraph needs an individual budget.
Not individual. We are not working on budgets yet. Each paragraph, it's information to generate the budgets. So each paragraph will need an individual table.
Oh, okay.
Like this, you see? Tables. We are not doing the budgets yet. You are just gonna collect the information. Remember, that's the first step.
Yeah, okay, thank you.
First step, identify the relevant activity levels, all right? So we're doing that, and you're gonna do it in the raw case scenario, okay? So if there are not any more questions, guys, regarding the homework or the class, we will end the class here. Do you guys have any other questions?
No, teacher.
Are you sure?
In case you have a question in the homework, like during the weekend, what's the Discord account or how can we contact you?
Send me an email, and the Discord account, it's supposed to be here on. Well, send me an email better.
Okay, thank you, teacher.
Yeah, because I don't see the Discord account here yet. Okay, so I think that will be it. See you next week, guys.
Okay, so we send you an email, right?
Yeah, send me an email with your questions.
Okay, thank you.
Thank you,
Bye.
teacher. Goodbye.